Hey there, and welcome to our quarterly economic and market update. I'm the CEO, Corey Wastle, and I'm joined once again by Tom Schubert, Managing Partner at Drummond Capital. Tom, thank you for joining us.
Hi, Corey. Good to be. Thanks.
Great to have you here. I'll get you talking in just a moment. I know, as always, you've got plenty to share. Today, we're going to start with the Australian economy. We're going to be talking in particular interest rates and inflation, two things that are very topical, and I think touching the budget, the household, and the financial well-being of most Australians at this point in time. Then we'll go abroad, have a quick chat about the US economy, what's happening there, and what that might mean for us. And then we'll shift gears and move into investment markets and what all this economic talk means for what we're seeing on share markets and in other asset classes. What we might perhaps expect as we move towards Christmas and into 2024. So there's plenty on the agenda. We're going to try and pitch it with as little jargon as we can, but it'll probably find its way into the conversation just a little bit. Now, Tom, as I said, let's start with the Australian economy. Last week, we saw our first rate hike in a little while. The cash rate's now gone up to 4.35%. So that means that if you've got a standard variable mortgage, you're probably paying over 6% at this point in time. Tell us a bit about why the RBA made that decision to raise rates last week.
Yeah, it's a great point. Look, I'd say Australia's actually been far more, the RBA that is, far more measured in its approach to raising interest rates. If we look at the US, they've been a lot more aggressive. They've already made it from 0 to 5.5. So we're a little way behind where other parts of the world have been. So they've sort of taken steps and they've paused and observed the economy. But if you're not aware, the RBA, like a lot of central banks around the world, is explicit in it's an inflation targeting central bank. And inflation must be between 2 and 3%. And they do, over time, observe things like unemployment and financial stability around, decisions on whether to raise or cut in the short term, but ultimately over the long term, their target is to have inflation running between 2 and 3%. And at the moment, we're still close to 4. And if you review the RBA's statement on monetary policy, which came out with that rate increase, it was clear in their own forecasting, inflation is going to remain above that 3% top of the band right through to 2025. So on that basis, when you've got a sort of medium to longer term outlook that means they're outside of their own target, then really they have to continue to hike rates until that inflation comes down into target. So they are being patient. They are observing that we've come a long way. The economy has slowed down. There's pressure on housing building or sort of construction activity and retail. So they know that there is some weakness from those rate hikes, but at the same time, they still haven't gone all the way on inflation.
Yeah, so I mean, in terms of the downstream effects of these interest rate hikes we've seen the last couple of years, maybe you speak briefly to things like consumer spending, saving rates, and so on. And what are Aussies out there likely feeling at this point in time? And what are your views on when they might get some relief in terms of those rate cuts, perhaps late next year, or as you said, maybe in 2025?
Yeah, it's a tough one. So on the savings side of the economy, so if you're a pensioner or a retiree and you've accumulated a pool of savings, you're actually earning more on that savings now through your investments or cash, etc., because you've got a higher interest rate. And that's actually propping up some parts of the economy from a consumption perspective. So people are still travelling or eating out. So the higher end or those with accumulated savings are in a better position as a result of higher interest rates. However, unfortunately for younger households is where you're seeing more of the pain. Like if you're at that early stage where you've got, young kids and a mortgage and your salary is not keeping up with inflation and rates have gone up materially, then your discretionary spending's really been impacted by the higher interest costs you're paying on your mortgage and plus the inflation that we're seeing across the economy. So it's a bit of a haves and have-nots, unfortunately, as it often is, and you can see it in retail results. So if you're looking at a high-end restaurant, when you go out around town, they still seem to be pretty well booked out. But if you're looking at sort of mass market retail, consumer discretionary, we can see signs of that slowdown.
Yeah, yeah, well said. And as we continue to get inflation under control, that's a positive. But the downside is that the prices will stay as they are. So if cheaper,
Prices never come back.
yeah, exactly right. If burgers have gone
Just,
from $11 to $15 over the course of the last 2 years, they're staying at 15.
yeah.
So some of the pain will persist for a little while.
And incomes need to catch up, right? And so that takes a bit of time. So you need that income growth to come through until you see that sort of positive income story re-emerge. And one of the disturbing things was the OECD, which looks at all the developed economies around the world, actually showed that Australians, more than any other developed country, have gone backwards in real income terms. So, essentially income growth adjusted for inflation. More than other economies. So we haven't seen the same pickup in wages to keep up with that inflation. So the RBA really does need to get it under control so that we can continue to feel wealthier and spend again.
Yeah, well said. All right. Let's take a flight abroad to the US and have a quick chat about their economy. Last time we caught up, last quarter, we were talking about this concept of a soft landing, which in short is basically getting inflation under control without employment really spiking and a recession being a consequence. We were talking about the US having kind of navigated that quite well to this point. Inflation was coming backwards probably faster than almost all other developed countries. And they were maintaining that low unemployment, as I was saying. So over the course of the past 3 months, what's happened with the US economy and where are they now?
So on the economic front, that soft landing, has certainly looked like the base case in the sense they had a really strong GDP growth for the quarter. The unemployment rate remains low. The economy as a whole is still doing well. The implications of that are that inflation has stopped falling. In fact, last month it ticked back up, so their core inflation's back to 4%. Tonight at 12:30, if you want to stay up like some of us and see what the print will be tonight, we'll see whether it's going to be another higher than we expected sticky print, which is bad for markets, or potentially that was just a one-off last month and the downward trend continues. So we're watching that quite closely at the moment because after falling all year, inflation last month in the US turned back up, and we'll get some more insight on that tonight. Yeah. That's had implications from a markets perspective on the bond market. So bond yields in the US over the last couple of months have sold off really aggressively. So they went from under 4% to above 5% at one stage. They settled back down a little bit from there. And that's really been one of the big catalysts for some of this equity market volatility that we've seen over that period as well.
Yeah, okay. Well, before we jump into equity markets, just take 30 seconds to explain, I think for at least half the people that will watch this, what bond yields are.
So when we talk about bond yields, we're talking about the yield on what we'll say are risk-free assets, and that is basically the government's borrowing costs. So governments around the world finance themselves in bond markets, and they're issuing 2-year bonds, 5-year bonds, 10-year bonds, 30-year bonds, so long-term interest rates, and the rate at which the interest rate on those different terms gives us like a long-term essentially slope of what the cost of money is over time. And that's like a reference rate for everybody else in the economy, for banks, for corporates, and ultimately there for the consumer as to what we're all paying, what the cost of money is. So when we're talking about bond yields, we're talking about that risk-free, long-term government rate.
Yeah. Okay. Thanks for clarifying, Tom. So with share markets specifically, the July to September quarter had quite a bit of volatility. We saw some declines across global markets. I think the US market at a point during that quarter was down maybe 10, 12%. You can confirm our market perhaps similar. What has been behind those declines? But also noting that in the last 3 to 4 weeks, markets have kind of bounced off those recent lows as well. So maybe give us some context around that too.
Sure. So a big driver is bond yields. And so really that risk-free interest rate sets the valuation for all other asset prices. And so when the risk-free interest rate goes up, all else equal, the valuation of other assets comes down. And so that really sharp sell-off or increase in bond yields triggered some volatility, some profit taking in the share market, particularly in the US and some of the more expensive, highly valued names in the tech sector. That sort of combined with the earnings season in the US as well. And so, the Magnificent Seven, the big tech stocks, but also more broadly just across the market, gauging where earnings were at. And in some parts of the market that had performed really well, expectations were for really strong earnings. So big tech stocks that had run a long way all year. And then when they actually got to announcing their earnings, realizing, yeah, that was still good, but maybe not quite as good as what was baked into the share price. And so things like Google and Facebook, we saw down, 10%, albeit they've had a really good run so far this year. So some realistic profit taking on the stocks that have taken the market higher. At the same time, witnessing under the hood stocks that are probably a bit more exposed to the slowdown in the global economy, also not doing as well. And so that sort of earnings combined with, higher rates drove that volatility. And to answer your question, yes, we've seen a little bit of a bounce back recently, also driven by exactly the same things. Bond yields coming down from 5 to about 4.6, so a little bit of relief on that side, but also concluding the US earnings season with some more positive results.
Yep. Okay. So just on the bond yields rising and that causing a decline and some volatility in share markets, I think for a lot of the viewers, that's probably a little bit confusing at this point. So can you just kind of give us a little more detail or context there around, like, as interest rates go up and those yields on government bonds go up, why would that have a natural effect on share markets and likely see share markets to have at least a small decline?
Yeah, sure. So back to valuation, ultimately the returns that we generate from any asset, whether it's property or shares or cash or bonds over the long term, really the starting point is the price you pay in the valuation. And so the cheaper the valuation, often the higher the return you can generate. And so a big input into determining the valuation of any asset is the interest rate, whether that's the interest rate you're borrowing at, today or into the future as measured by those bond yields. So all else equal, higher interest rates should mean a lower value today, all else equal. And so as we've seen interest rates rise really quickly, we've also, since that process really started at the beginning of last year, has really been when we started to see a lot more volatility in equity markets or property markets, as the world's adjusting to what is the new normal level of interest rates that we should be thinking about from a valuation perspective and a funding perspective.
Yeah. Okay. And I think just even simplifying what you've mentioned there around bond yields and share markets, if you're an Aussie and you've got a lump sum of money and you're thinking about, should I put this into cash, into a term deposit, into a bond fund, into the share market, what's the best option for me? If you can put money in a 24-month term deposit at, let's just say, 6%, that starts to look pretty attractive when you've got to take a reasonable level of risk and incur a reasonable level of volatility to try and generate an 8, 9, 10% return on share markets. So, for a lot of the last 10, 15 years post GFC, as rates have been down here, closer to zero than they are now, there's not a lot of incentive to move into those defensive assets because the returns are very minimalistic. But now on those defensive assets like cash, like deposits, like bonds, there are relatively attractive levels of yield. So incomes you'll get from those investments. And it means that risk premium to go into, say, the share market isn't necessarily as attractive for everyone, particularly those that they're a bit older or, closer to retirement or in retirement as well, as you mentioned earlier, Tom. Did you want to add anything to Tom?
Yeah. And that's why it's a big, in the portfolios, the overweight position is within bonds and corporate bonds where we're actually earning sort of 7%, pretty risk-free, if that makes sense. And so we think that's a nice, attractive anchor to have in portfolios. And that return was not available even 12 months ago.
Yeah, I think for those that are in a balanced portfolio, it's much easier to generate a reasonable return from that portfolio in the environment we're in now, and likely the one that we've got moving forward, as opposed to the last decade or so, where there's been very little return on those defensive assets we've been talking about, and you've needed to deploy your money into stock markets and, and riskier asset classes to try and generate your returns. Now you've got more choices, which I think is a good spot to be for many. Just broadly with share markets, thinking perhaps about, the Australian market and the US market, do you have views on whether these markets are currently closer to being expensive, or closer to being cheap and attractive, or maybe closer to fair value?
On a relative basis, you speak to bonds versus equities, they're still somewhat unattractive, but equities, if you think about it now, share markets for the last 2 years kind of been bouncing around quite a wide range and actually point to point not delivering really on capital growth. And so, but through that time, have managed to actually grow their earnings. And so they've become cheaper over time, and there are becoming parts of the market now. If you look at smaller companies, so out of the large cap blue chip part of the market, that are back sort of at pre-COVID levels, like becoming quite attractive. The catalyst for them to move higher is a really big rebound in global economic growth. And so these are areas we look at and go, oh, they are becoming more attractive. And so when you look out and get more constructive on the outlook, i.e. inflation stabilised, we've done with rate rises and we're closer to rate cuts, at that point there's actually lots of great opportunities, I think, out there in the equity markets to buy. But at the moment it's sort of, they're becoming more attractive. But given that we're not at the end of the inflation cycle and the end of the rate hiking cycle, the relatively more attractive part is actually those assets giving you that yield. But it's a good time to be diversified because you're sort of being paid to wait in those assets, getting decent returns, whilst the valuations are getting better in versus history on the growth side, the equity side. And at some point when the outlook improves, those assets will start to appreciate and you'll get the growth again. And so you're actually, being in a diversified portfolio at this point is, it makes sense because you're getting paid to wait for that inevitable recovery.
Yeah, well said. Paid to wait is certainly something that that we can cling on to. Last question for you around markets is, the conflict that's happening now, sadly, in Israel and Palestine. What effect has that been having on markets, and what effect may that have going forward?
Very early days of the September quarter volatility, it had a moderate contribution to that, in the sense that the oil price started to rise again. And again, when we're coupled with this worry around inflation, that's obviously the big concern. I think, now I'm talking purely markets perspective because there's obviously a terrible humanitarian crisis yet again in the region. But the oil prices subsequently come off those highs, and despite the sort of sticker shock of what you see on the news, it looks more, there seems to be a lot of pressure from, both the Arab states who met together for the first time in a long time over the weekend, but also from, the US on Israel to try and form some kind of ceasefire/solution. So the war it's really just between Hamas, who is classified by us and many countries in the West as a terrorist organisation. It's not between two nation states, and it's retaliation for what they did within Israel. But potentially what comes out of this, because it has been bloodied, is a more sustainable solution, either the UN or the Arab states getting together to govern and rebuild a Palestinian state. Part of the reason of the conflict is that Palestine is in essence funded and governed by Israel, and that's created the ongoing conflict between the two sides. And so maybe this brings it to a head to come up with a much better long-term solution, and hopefully that was what was being discussed by the Arab states over the weekend, because it's devastating to watch. But at this stage, absent Iran or Saudi Arabia or the US actually getting directly involved, like troops on the ground retaliating at each other, attacking critical energy infrastructure, from a markets and global growth perspective, it's not really a concern. So we're just watching for it to flare up. If it does flare up and looks likely that scenario, then that's a reason to take action. Right now, from a portfolio perspective, there's nothing that we should be, too worried about, if that makes sense.
Sure. Yeah. Okay. And I appreciate your words on the sensitive subject. For those that haven't read it, I would encourage everyone to read the statement from Barack Obama a week or two ago on the conflict and potentially, the way forward to move beyond the conflict, but to, a better solution that's more sustainable in the long run as well. On that note, Tom, I'd like to wrap up. Thanks again for your time and your knowledge as always to our clients that are watching this today. If you've got any questions, get in touch with your financial advisor or our team. We're always here to chat. We hope that you are well and we look forward to speaking with all of you very soon. Thank you, Tom.
Thanks, Corey. See you next time.
Cheers, guys.